Could Microsoft be the undervalued titan in today's tech market? With rapid revenue growth, a stronger balance sheet, and bold advances in AI and cloud services, Microsoft's financials hint at untapped potential. We'll examine the figures behind their $523 billion in assets and the forecasted doubling of net income. Is Microsoft the value investment that everyone is missing? Let's dive in. Founded in 1975, Microsoft Corporation has become a technology giant, dominating personal computing and enterprise software. Its Azure cloud platform is experiencing robust growth, challenging competitors in the cloud space. Microsoft's diversification and consistent revenue streams indicate strong financial health, which may appeal to value investors. Microsoft's balance sheet reflects a strengthening financial position. Cash and equivalents increased from $18.3 billion to about $20.8 billion, signaling strong operational cash flows. This increase enabled Microsoft to reduce total debt from approximately $102.9 billion to $96.8 billion, aligning with their strategic focus on debt reduction. As a result, the debt-to-equity ratio improved from 0.364 to 0.337, indicating a healthier balance between debt and equity financing. Retained earnings have grown significantly, showcasing robust profitability and a commitment to reinvesting in future growth opportunities. Additionally, Microsoft holds substantial treasury stock from share buybacks, over $102 billion, which demonstrates their dedication to returning value to shareholders. These elements highlight Microsoft's solid financial foundation and potential for sustained investor returns. Microsoft's total assets have increased to $523 billion, driven by higher values in property and equipment. This reflects strategic reinvestment, bolstering long-term growth potential. By enhancing their asset base, Microsoft is positioning itself favorably in terms of asset management compared to industry competitors. Microsoft's income statement shows strong profitability, with the net income margin rising to 37.6% by September 2024. This indicates efficient revenue management, even with increased investment costs in areas like cloud services and gaming. The significant growth in earnings per share by 36 cents highlights impressive performance. Although the gross margin slightly decreased to 69.3%, it still reflects operational efficiency amid strategic investments. Notably, the selling, general, and administrative margin decreased from 14% to 11.3%, highlighting successful cost control. Management's disciplined approach to cost during expansion suggests they are well positioned to sustain revenue growth. Microsoft's revenue has grown significantly, driven by strong performance in services. However, a slight dip in product revenue indicates potential challenges in that segment. Importantly, operating income surged by $3.7 billion, showcasing effective cost management and operational efficiency. For value investors, this strategic efficiency may position Microsoft favorably in a competitive market. Microsoft's revenue has steadily increased, reaching $65.6 billion, while net income expanded to $24.7 billion by Q3 2024. This growth results from strategic initiatives in cloud services and gaming, strengthened by the acquisition of Activision. Elevated operational and capital investments have fueled this expansion, though they may narrow profit margins in the short term. The profit margin, the percentage of revenue that becomes profit, might shrink now, but is expected to enhance long-term growth in the cloud and AI sectors. These investments align with future market trends, positioning Microsoft advantageously despite potential short-term impacts on profitability. Investors should consider how these strategies affect the company's long-term value. Microsoft demonstrates robust cash flow efficiency, generating $19.3 billion in free cash flow this quarter, with a high free cash flow yield of over 59%. This indicates effective conversion of revenue into cash that can be used for investments or shareholder returns. The capital expenditure margin, near 60%, reflects significant investments in strategic assets, fueling future growth. However, stock-based compensation remains substantial at $2.8 billion. While common in tech firms to attract and retain top talent, it can dilute shareholder value. Compared to industry averages, Microsoft's free cash flow yield is higher, signaling solid financial health. Overall, management's prudent cash flow management and strategic investments position the company favorably for long-term value investors. Notably, Microsoft's net cash from operations increased by 12% year over year, reflecting strong operational efficiency. However, substantial cash outflows and financing activities highlight significant dividend payments and share buybacks. While these return value to shareholders, they could limit liquidity for other investments. Maintaining a balance between rewarding shareholders and investing in growth is essential to ensure long-term sustainability and competitive positioning. Analyst estimates forecast Microsoft's net income nearly doubling to $173.7 billion by 2029, suggesting robust growth potential. An expected rise in earnings per share to $23.30 underscores this optimism. Such projections reflect confidence in Microsoft's strategies in cloud computing and AI. However, this aggressive growth assumes Microsoft can successfully navigate competitive pressures and allocate capital effectively. Investors should consider whether these expectations are realistic given market dynamics. Comparing Microsoft's projected margins to industry peers could provide insight into its competitive positioning and validate these optimistic forecasts. In the latest earnings call, Microsoft reported robust revenue growth, primarily driven by its Azure cloud services. The strong performance in cloud computing highlights Microsoft's pivotal role in this high-demand sector. Conversely, there was a modest slowdown in the personal computing segment, which aligns with broader industry trends. The company emphasized its strategic investments in artificial intelligence, aiming to integrate advanced AI capabilities across its product ecosystem. This focus on AI innovation may enhance Microsoft's competitive positioning, but could also impact short-term profit margins. Evaluating these investments in relation to profitability and comparing them with competitors' spending is essential. Understanding how Microsoft balances growth initiatives with financial efficiency provides valuable insights into its potential as a long-term value investment. Microsoft's price-to-earnings ratio of 38.5 aligns closely with peers like Adobe at 41.5 and Palo Alto Networks at 40.2. This ratio indicates how much investors are willing to pay for each dollar of earnings. This similarity suggests that the market views Microsoft's earnings potential comparably to these competitors. Its price-to-book ratio of 12.6 means investors pay over 12 times the company's book value, reflecting strong confidence in future growth areas like cloud computing and AI. However, high price-to-earnings and price-to-book ratios imply the stock is priced for continued growth, so any slowdown could affect its valuation. Compared to companies like CrowdStrike, which has a price-to-earnings ratio of 781, Microsoft's valuation appears more reasonable. Nonetheless, ongoing innovation is essential to maintain its market position. Analyzing Microsoft's discounted cash flow valuation reveals significant potential, but also notable volatility. The discounted cash flow method estimates the value of an investment based on its future cash flows. Under various scenarios, the projected equity value per share in 2029 ranges from approximately $260 to $390. This spread highlights how sensitive Microsoft's future value is to both its strategic investments in cloud and AI, and to broader market conditions. The optimistic scenario suggests robust growth, while the pessimistic scenario warns of potential downturns. Such volatility isn't uncommon in the tech sector when compared to peers. Investors should consider how Microsoft's commitment to innovation might drive value while remaining aware of risks in fast-evolving markets. Analysts forecast Microsoft's stock price reaching a high of $600 within 12 months, with an average estimate around $495 and a low of $425. This reflects strong confidence in Microsoft's growth trajectory. The steady climb from $150 in December 2019 to over $429 today highlights successful investments in technologies like cloud computing and AI. This consistent momentum suggests robust financial health. However, investors should remain mindful of competitive pressures and broader economic factors that could impact future performance. Microsoft's strong financial foundation, with rising cash reserves, reduced debt, and significant retained earnings, highlights robust operational health. Strategic investments in cloud computing, AI, and gaming, though impacting short-term margins, align with future market trends and position the company for sustained growth. High free cash flow and effective cost management underscore financial efficiency. While valuations are elevated, they reflect confidence in Microsoft's earnings potential. Analyst projections of substantial net income and earnings per share growth support this optimistic outlook. For value investors, Microsoft's combination of solid fundamentals and strategic foresight may present a compelling investment opportunity that many may overlook. Make sure to watch another video from our Value Explorer series by clicking the playlist below.